And we've now had a chance to look at the fine print of Budget 2022, where the government lays out the roadmap that it intends to follow to ensure that India lives up to its potential of being the fastest growing economy in the world. And clearly the government intends to spend because private consumption and private spending is not expected to recover as quickly as some had forecast. So the thrust on infrastructure and a few other sectors is expected to drive India's growth forward as well. Now, from the perspective of an investor looking at India as a market to invest in, this presents an opportunity, and we're not saying that you should overhaul your investment strategy, but certainly focusing on some of the key themes that will play out over the next several years will be interesting to do with the budget now in the rearview mirror. Joining me now to talk about the key themes from Budget 2022 and how you should adjust your investment strategy is Vivek Bajaj, who is the co-founder of StockEdge and Elearnmarkets. Thank you so much, Vivek, for taking the time. Certainly the equity markets, I should stipulate, seem to be cheering the budget, which I think a lot of people have pegged as pro-growth. What are your initial reactions? And then we can go into some of the key sectors that you've highlighted.
Sure. So thank you so much, Alex, for having me. Either you can have an intelligent budget or you can have an emotional budget. I think this budget government preferred to keep it intelligent. And it has definitely appealed to the intelligent class because they are understanding, we all are understanding the implication of this budget for coming 25 years. And stock market, because after a point of time, intelligence works there. So stock market is also cheering the overall budget. I think the current situation where we are in, where inflation is high and growth is coming in our economy in pockets. So there are a segment, an industry segment where people are getting a lot of money, people are making good margins, especially the raw material and the metals and other sectors, they are making good money. But then there is a pocket of service where people are not making money and there is unemployment. So I think this budget, government has maintained a phenomenal balance in giving growth impetus. And it was largely a top-down budget, I would say. Typically, it's a bottom-up budget where they decide that we have to please these many people or we have to introduce liquidity into the system by doing this. But this time they have done more top-down, looked at the core problem, which is growth and unemployment, tried to solve that problem with inclusive growth, and then probably hoping that this will lead to a large-scale penetration in our country.
It's interesting that you point that out because they have clearly talked about how much they're going to spend, and it's going to be a massive spend on infrastructure, among other things. And certainly the bond market is a little bit jittery on that market borrowing number, which is close to 15 lakh crore rupees, which is why you saw bond yields spike. But Vivek, let's talk about things from the equity investor's perspective. Since infrastructure is the big thrust, and I believe Finance Secretary was speaking in an interview not too long back, and he spoke about the fact that private consumption, private spending is unlikely to pick up very quickly, which is what explains the thrust towards infrastructure. But how can an investor play that theme?
Okay, so broadly, let us classify the market into consumer-led sectors, and other are more on macro sectors, right? Although we can have many more classifications, but broadly, for the sake of today's discussion, let's do that. So consumption-led sectors like auto or real estate or you have banking, because interest rates are low, generally the propensity of high consumption is high. Because who would know that home loan at 6.25, 6.5%? I have not seen this kind of rates in my lifetime. So there are many people who are buying houses because interest rates are low. So that consumption-led growth will happen because interest rates are low. But the problem is with respect to non-consumption-led growth, which is the macro. And there the problem was, and the problem has been solved. So I would say that there will be sector rotation. Some sectors were leading in last 2 years because of pandemic, because of overall growth in consumptions. But now the sector leadership will change. Infrastructure, cement, iron and steel, and these further sectors will gain more prominence. So I would say that investors who have invested till date, they had a philosophy that, okay, I'll get into those sectors where consumption is high. I would say there's no harm in adding more sectors now which have been underperformer. And I would say coming 2-3 years, definitely you will see more moonshots in those sectors than in the traditional sectors which have been performing in the last 2 years.
Okay, I want to speak a little bit more about the health of a few of the infrastructure companies. Now, if you look at the journey between 2000 to 2010, one of the learnings is that quite a few of these companies, quite a few of the big infrastructure companies took a lot of leverage, took a lot of debt, and therefore underperformed once things went bad. How do you approach this sector? What are the parameters that you would say are most important to focus on? And if you can name a few frontline stocks or stocks that you think will benefit.
I think in infrastructure also, one has to focus on companies where themes are clearly identifiable. And obviously leverage is a core requirement of this sector, because without lending, without borrowing, these sectors, they cannot execute the projects which they have in hand. So certain stocks which are extremely theme oriented, and these are not recommendations. For example, L&T. Now, Larsen & Toubro is not just an infrastructure company, it's the mother of a lot of other companies. So it has embedded value inside that company. So that is one company which clearly comes into our mind immediately for a retail investor, because it has a lesser risk profile. For example, a company like GMR, which is now getting distributed into two companies, and we know that airport growth will happen. So there is a theme of airport growth attached. So one should not just look at blanket comparison of all infrastructure companies on the basis of PE or ROE. I think every infrastructure company has a theme attached. And if you're convinced with that theme, then you can probably participate in that infrastructure company.
What do you need to bear in mind, Vivek, when it comes to cement? I guess a few schools of thought here, right? If you talk about the kind of geographical spread, one might say that you should bet on the market leader, and another might say that you should look at the ability to gain market share, right? So how would you look at this, and therefore what are the parameters that you would identify?
Well, the conservative investors will always like to look at the top 3, top 5 market leaders, because cement is such an industry where market leader always has an edge over other people. But an aggressive investor would also like to explore companies which are coming up strong, or maybe companies which are regionally very strong. I'll give you an example. Again, not a recommendation. Say, for example, Star Cement, which is predominantly based on Northeast. And in this budget, a lot of discussion was made in terms of uplifting of Northeast. So Star Cement could be one stock which you would like to track. Not a recommendation, but I'm just giving you an example. So either you are conservative investor, you want to bank on that sector growth, just invest in top 3, top 5 leaders of that sector. Or if you want other smaller ones, which has potential to give you more return, then obviously you need to get into that stock specifically and find out what's the underlying theme inside that stock.
You've also identified iron and steel as a sector to watch, and certainly the metal pack as a whole has been shining brightly all of 2020, 2021 as well, right? Because of the way the underlying commodity has moved. But again, on the flip side, Vivek, one might argue that these are cyclical sectors. Would you bank on the commodities staying, or the prices staying stable for the coming years? Certainly these companies have managed to deleverage in a big way, so that is a positive, right?
Right. So you're absolutely correct. These are cyclical sectors, but we have to understand that this is the current cycle which is going on. So when will the cycle end is anybody's guess, right? What I see that coming 1 year, the cycle of commodity is still intact. And I'm not seeing, dollar giving huge surprises on the upside. So I would say that I'll still bet on commodities stock, because there is inherent demand. There's a huge growth which is coming at a ground level. Talk to your friends who are in iron and steel. They will tell you that what kind of price they are seeing in iron and steel. Obviously, the consumer of those iron and steel stocks like real estate, etc., they will suffer. But till they have the pricing power to shift that cost increase to the final consumer, they are fine with it, right? So iron and steel, yes, it's part of a cyclical business, but I feel that this year we still have commodity cycle intact.
It's interesting you say that, because in the sectors that you've identified, none of them are really the sectors that would have to pass on those increases in commodities. You mentioned the auto pack as an example, right? And all of these manufacturing companies have had a problem with their margins in the recent past. But let's talk about the next one, real estate, housing. It's something that has seen incredible traction over the course of the last year. SOPs given by a few local governments, but primarily the interest rates where they are, right? How do you see this panning out, and do you anticipate significant growth for the housing sector as a whole?
So in this budget also, government again talked about affordable housing and allocation for that segment. But real estate, if you talk to people at ground level, they will say that there is a massive demand for ready inventory. And obviously, as the ready inventory is getting exhausted with the pent-up demand, the ability of a consumer to bet on future inventory is still low in India. Having said that, we have seen in last 5 to 7 years, massive inventory supply side across the region. So yes, I would say real estate, till the interest rate is here and not going to increase in a hurry, I think real estate is still there as a good sector. But please, I would request, look at each stock, because every stock has a dynamic. For example, a real estate stock out of Bangalore will do very differently because the demand dynamic is so different out there. So many startups are getting funded. Ultimately, all the employees, people want to go to Bangalore, settle in Bangalore. So obviously, there is a high chance that the real estate company based out of Bangalore will see much better growth than in other cities. So real estate is largely a regional play, except Godrej Properties or DLFs of the world. So I would, and I've invested also in some specialized real estate players which are focused on specific regions.
Just a follow-up, Vivek, when you're looking at real estate companies, more so than others, would you look at cash flows, considering that this is going to be a clear barometer of how the company is performing? What specifically would you look at as a potential investor into a real estate company?
So when we talk about sale of the ready-made inventory, then cash flow becomes extremely important. And that's where we are seeing that at this juncture, ready-made inventory is huge demand. And if that demand is not getting converted into cash inside the company, then there is something definitely a worry of concern. So you are absolutely correct. And the bigger problem with real estate traditionally has been cash flow mismanagement, because of which they have to take leverage and the company goes for a toss. So I think cash flow, not just real estate, I think any broader macro infrastructure company, cash flow has to be tracked very, very closely.
Okay, now you've identified banking as a potential gainer on the back of Budget 2022. And of course, you need somebody to be funding the India growth story. But I'm just curious how this is going to play out. You're talking about the potential for interest rates to go up, not just in India, but globally. You're already seeing yields on the 10-year benchmark going towards 6.8 or thereabouts. And that is a precursor, isn't it, Vivek, for interest rates to go higher. Is that a threat to credit growth?
See, the growth and inflation, those two are the, balancing, and interest rate is actually the one which balances both of them. So yes, inflation is going up, and because of that, interest rate is supposed to go up. But then the growth is so high that probably that whole differential is getting negated. So banking is the core of business activity. And you see the consumer finance, the way things are growing, with a lot of fintechs getting attached to banks and providing loans to all of us. And we all have increased aspiration to live a better lifestyle. So I think consumer finance is definitely in for growth in India. There is no second doubt about it. But obviously, the corporate lending, which was slowing down and there was poor credit offtake, that I think will get boost. And that's probably the reason why this budget is so important. Because the moment government pushes the growth from top to bottom, corporates get a lot of benefit. The corporates which were facing a lot of trouble, I think banks also attached to the corporates who are facing trouble. For example, public sector banks, etc. All of them will witness fair bit of recovery in their overall business.
Do you think that the model has changed though? That companies will look to go out into the market themselves to raise funds rather than depending on banks, and banks also are averse, right? If you think about it, banks like ICICI Bank, which traditionally or several years back, Vivek, had a dominance in the corporate lending, have now pivoted entirely towards retail. The retail book is now higher than the corporate book. So how does an investor play this?
So when you talk about private banks, I totally agree that they have moved more towards retail because they see more stability there, although the margin is lesser, but they feel that's more comfortable zone. But talk about the public sector banks. Now, there obviously still corporate lending is a main source of their net margin. So I would say the current rally in the banking, obviously consumer finance is leading that rally. So that's why ICICI Bank is today quoting at this price, or other banks who are more tech savvy, they are quoting at a reasonably good price. But if you talk about other banks, which were kind of a drag for Bank Nifty, they are also rising to the occasion because they see that growth of corporate lending probably will go up. Just answering your question, companies will go directly to borrow. Well, companies do go directly to borrow, but that's largely for the equity raise. For corporate borrowing, I think banks still is one of the predominant source of borrowing from the market.
Okay, certainly. The last sector that you've identified is technology, and this is quite a wide sector, wouldn't you say? So what specifically are you talking about, Vivek, in this? Because IT as a theme, I think a lot of people are betting on, but how is it related to what the government is saying in Budget 2022?
So if you hear the budget properly, digitalization, digital technology, I think these were the most used term in that whole speech. And the intent is very, very clear that the whole governance has to be shifted to e-governance. They are promoting startups which are using technology to solve complex problems. For example, agri-tech. The finance minister spent so much time on talking about the need of a proper agri-tech ecosystem. So the whole concept of technology comes out of the intent of the government, and we are also witnessing the same experiencing the same in our real life. That technology has become so important. But will that convert into business for all tech companies? And do you invest in all tech companies? I'm not saying that. I'm saying there are still pockets where companies which are more product driven, catering to customers, which are adapting to new technologies, those are the companies where you would like to bet, because technology is here to stay. And it is not just about us, it is also about the government showing the intent of adopting technology.
So what I was getting at, Vivek, is that you have the frontline IT companies. And clearly quite a lot of their business is coming from abroad, right? So yeah. What companies would you look at, or what themes within the tech industry would you look at that will focus on the India growth story? And clearly, obviously, the government is digitizing. You're talking about e-passport. You're talking about various other, efforts that the government has on digitization. You're talking about blockchain technology. So where do investors look? I'm asking you to narrow the playing field.
Sure. So, unfortunately, most of these tech startups which are into the new modern tech are still unlisted. So, and they will come into the market, get themselves listed, and you will get opportunity to participate in their investment. In fact, people who love to invest in unlisted space, they will find enough opportunity there, either as a startup investor or as a follow-on investor. Having said that, the listed space, talk about the top 3, top 4, which are largely dominated by selling to global audience. The mid-cap ITs, although they have grown so much, but I'm sure you will find corrections happening in them. And every correction in IT basket should be seen as an opportunity. That's my point of contention.
Okay, fair enough. And we've touched upon quite a few sectors, quite a few ideas. Vivek, thank you so much for joining in and for sharing your perspective. I think a lot of our viewers will have benefited enormously from it. And guys, if you have any questions, do let us know on any one of our social media platforms and we'll help you out, or we'll attempt to help you out with any questions that you might have. Vivek, always a pleasure speaking with you. Thank you so much.
Thank you so much. Bye.